Good afternoon and welcome to MarketCast XII. It's our first birthday, and so we've introduced a load of changes. The first one of which, of course, is it's 4 o'clock in the afternoon. It's wonderful. It saves that early start and getting up and having to try and smile at 8:30 a.m. And we've got one or two other surprises for you as well today. This MarketCast comes to you live from London, from the Oliver offices in Rosebery Avenue in town, and in due deference to being Rosebery Avenue, I've got the MarketCast shirt on, the 12 shirt on, with the roses on as well. So that's great. And not only that, in a break from tradition on our first birthday, we've found ourselves a guest, our very first guest on MarketCast. And it's interesting because I've talked to you before about the left brain, right brain nature of actually trying to forecast what the property market's going to do, having all the data, having good solid statistics, and marrying that with that visceral feeling and experience inside that left and right brain. Well, today we've got somebody with a very special left brain who's going to turn the art of the possible into the art of the probable. Ladies and gentlemen, I'd like you to introduce you and you to welcome Mr. Richard Donnell from Zoopla. Richard, good afternoon and welcome to MarketCast, our first ever guest.
Thank you very much. It's fantastic to be here.
It's a little bit of a sort of white knuckle run, really. Everything live, everything unrehearsed. The nice part about it is having you here. Now people can see it truly is a live thing. So, probably a little bit more hell for leather than your normal things that you do. But so let's kick it off. And what I'd like to do is kick off with some of the stuff that we've seen in the press since the classic mini budget of last year. I was saying just last week, that mini budget thing puts me in mind of a mini Magnum. It was only small and was gone in moments, but it made you feel pretty sick afterwards. And these were the sort of comments that the press had to say. We had a lot of plunging and nosediving and plummeting. But then, of course, Jeremy Nice But Dull came along and waved goodbye to all those crazy giveaways and the billions of pounds in tax giveaways and brought common sense back to the government. And of course, that is exactly what we needed. That's what the markets needed. In fact, it's what the world's markets needed to see was a little bit of common sense, a little bit, let's calm down everybody. And you'd think, wouldn't you? We started to see then a return to normal, and you would have thought that the press would have actually maybe relaxed their position from there. But no, this was a classic story that I picked up just the week before last. Unbelievable. And not only is the Telegraph in this story talking about the property market facing a reckoning, they're saying that the house price plunge, their words not mine, is only the beginning. And the graphic here shows a house literally falling away from the rest of the terrace and careering downhill. Now, what is quite interesting about this is that I actually went and had a read of this article. I wanted to see what their justification was. And in there, they quoted one of the UK property industry's most respected voices, a guy called, Richard Donnell. Richard, you were in there and you were quoted. And I've popped on here, the bit here where you're talking about the mortgage rates mean that buyers have 20% less to spend than the start of last year. Was that how you phrased that story to the Telegraph, or did it shock you?
Well, the headline shocked me because I saw the headline and thought, I'm in that story. But it's sort of, I think the media at the moment, to get attraction, to get clicks, they sort of, the sub-editors have a field day with some of these stories and to make them more enticing. But I think, what we said here was correct, and we're going to talk about it later on. But I think, look, the housing market is being far more resilient than the media believe it might have been last year and is actually happening now. And
do you get the sense that they're sort of feeling driven? Lots of people use the phrase self-fulfilling prophecy. And if you tell people often enough that we're facing a disaster or a boom, the other way around, it can actually lead to it happening. Do you feel that's behind?
I'm not sure what they're up to. I think it's all about it's what readers want to read. It's hyping up the titles to get the eyeballs on the story. And then as ever,
we call it clickbait.
It is clickbait. And I think, there's some hard facts here, but it's important for consumers because consumers are reading this and then making decisions. And so I think, it's just the way the world's gone. I've been talking to the media for about 20 years about the housing market, and I think I used to worry about saying things that would get on the front page when I was at Savills, and now I think you have to say something pretty extreme, almost outlandish, to sort of get on the front page. So it's just the way the media landscape has evolved.
In that piece, a little bit later on in that piece, you refer to buyers not chasing an aspirational dream, but being much more common sense about what they're doing and what they're buying. And certainly that reflects how I feel about how the market is right now.
Yeah, I think the housing market, booms and busts in the housing market have been linked to loose lending by banks.
Yeah.
And also then people just almost overbuying housing. Just I can afford a 5-bed, I only need a 3-bed, but I'll buy a 5-bed. And then when the kind of music stops, the economy weakens, mortgage rates go up, that sort of overpaying for property then leads to prices falling. And I just don't think that sort of rampant aspiration is around as much as we've seen in the past.
No, it's not what we've got at the moment. I talked to a group of sales team week before last, and I was telling them in the 80s that you could get 110% mortgage. Yep. So if you want to borrow £200,000 to buy this house, because the house costs 200 grand, we'll lend you 220. Yep. I mean, that's the sort of thing that we saw, wasn't it?
Yeah.
It was classic stuff. Okay. If I can set the scene, Richard, and we've got some great data of yours. I love putting the Zoopla stuff into my MarketCast presentations. Sometimes I'm not sure I absolutely nail it down. If ever you've watched me and thought, what a plonker. I don't blame you, but I do my best. But today, with having you here, it's a great time to get you to explain it in a little more detail. But I think the reason I've put the mortgage approvals up first is because I think this is a really good illustration of why the media have published some of those stories and how things they've got it wrong, and how the market in the last quarter of last year was a bit of a sideshow. We all know mortgage approvals, essentially back in those lovely easy days, 2014 to 2019, 60 to 66,000 a month meant we got about 100,000 a month completions. It was rock solid, nailed on, wasn't it? It was like this. And then we had COVID, and then this extraordinary market after COVID. And then we were getting back to here, weren't we? We were getting back to here. And then we had Kwasi and Liz with their mini budget or their mini magnum. And we saw this huge, but I don't know whether you feel the same as me, but my take on that massive drop in approvals was basically because people couldn't get mortgages. In the days after the mini budget, I think almost half of the available mortgage products were taken off the market. So what's going to happen?
Exactly. I think it's, and I think just people saw mortgage rates going from 2% to 6%, unheard of, cost of living pressures over the year, war in Ukraine. And so a lot of people don't need to move. You can afford to wait 3 months, 6 months, and that's effectively what's highlighted here. People just sat on their hands, and hence the mortgage approvals numbers dropped off.
And that little uptick there, these numbers are to the end of February, they're the latest. We're very, very close to the March numbers now, and I am absolutely convinced that we will see those numbers continue to decline. But so this created this picture, quarter four of last year, but it didn't, for me, reflect how the market was really moving. And I've stuck this chart in again. It's a bit more up to date now, because I love this chart in terms of giving us a really good snapshot of the market. This is Property Mark. So these are a group of estate agents who get together, share their reporting, and here are all the deals. You'll notice it's like virtually 100% of the deals that they did from March 22 to March 23. In the grey are deals that were done at below asking price. In the orange are deals that were done at asking price, and in the blue, extraordinarily, are deals that were done at more than the asking price, which is quite extraordinary when you think these were close to 40% of deals out there. People were paying more than the seller actually wanted. Quite extraordinary. And you can see how from March, April last year, that grey has spread out here, which is a really great indication, I think, of when the market went through its transition. Interest rates had started to go up here already. The Russia invaded Ukraine in the February. We'd already seen those cost of living pressures going on. This is where the market transition happened. I know the mini budget caught the headlines here, but we were already in that transition. And Richard, what I think is really interesting is when you start looking over here, it strikes me that December was the low point.
Yep.
And as we come here, and he said there's almost 10% of deals of these agents done in February were above asking price. And I find that quite extraordinary. I really do think that's a great shout. Picking up exactly what you said, I see this market shifting from the aspirational, I want this, I want a bigger house, I want a nicer view, into needs. So those people sitting on their hands, exactly as you say, that absolutely reflects my experience of it, and certainly those of my clients in and around the country. And really interesting to see as well, this is from the Property Mark survey, these are buyers registering and looking for a home, and the number of prospective buyers that registered per branch stayed really strong at 93 in March, and that's a really interesting curve in there, isn't it? So just fascinating numbers that I think give us a great reflection. So over to some of your great charts, and I love a good chart. And this was one of my favourites in the last deck that I saw of yours. Can you just talk us through this one?
Yeah, this is what we call demand. So people getting in touch with estate agents and house builders, getting in touch to book a viewing, find out more about the property. So we call it demand. It's an applicant lead, basically. And we take the last 5 years on a rolling 7-day basis, and we index it all to 100 is the 5-year average.
Right.
And you can see here in the black line the orange line was 2019 before the pandemic hit. Not a great year for the housing market, but not a bad year.
Yeah.
After the election, things picked up. Then we literally closed the whole economy down. So COVID closed down. Yeah. Then this huge spike in demand over 2020, rest of 2020. Rose again in the green line in 21. Rishi Sunak announced the stamp duty extension. Lots of people piled into the market, cooled off. And then, as you said, this time last year was absolutely red hot. Slowed off, the mini budget landed, and almost Christmas came early.
Great trend there, isn't it? I mean, if you want a trend, come on.
As rates come up.
It's just sat right there, isn't it?
And then the purple line is where are we? So we have bounced back. We're running ahead of 2019. If we factor on to Easter, at the moment, just after Easter, we got to the highest level on this line. So buyers are in the market. Buyers are in the market. They're more conscious, value conscious. There's different things motivating them and driving them, but there's demand for housing out there.
So if I was to be handing you a felt tip pen, I won't, because it's a very valuable Oliver screen here. Where would this line be? Is it going to poke its nose above this?
It's about here at the moment, and I think it might flirt with the 100.
Right, so coming back to the 5-year average is what you're saying.
Yeah, I think it'll be back to the 5-year average, but as we'll have a look in a second on the sales line, we're already above the 5-year average.
Well, let's do that right now.
So this is sales on the same basis. So you look at the number of sales agreed on a rolling 7-day basis, indexed to 100. Close the housing market down in 2020. That's what happened here. Yeah. It's a bit jumpy because on a 7-day basis, bank holidays, deals aren't done, etc. But the most important thing is, again, the purple line is now above the 5-year average. And if we roll forward, it's actually about 15% above the 5-year average at the moment. So I think there's a lot more homes for sale at the moment. There are fewer buyers, but I think there are more serious buyers. And I think one thing about last year was there weren't enough homes on the market. And I think there's some pent-up demand coming through from people who wanted to move last year, couldn't find anything, it was too hot. Then they sort of didn't buy in the final half of the year. So I still think there's people in the market that want to move, want to buy property. And that's why actually the sales numbers look almost better than the demand numbers.
Yeah, you see, I take the view, it's a funny thing. I never explain this terribly well, but I do believe that the property market does not play by the same rules of supply and demand as most others. Because there comes a point where if you take enough supply out of the market, then a stasis arrives. People say, well, there's just nothing to buy, and what there is crazy expensive, so I'm actually going to step back from it. You need fluidity, don't you, in the market? And of course, that will drive volumes. We'll talk about volumes later, because I want to see if your views tally with mine on where volumes are going to go as well. But if that journo, the one that interviewed you for the Telegraph story, is watching this, how do you think, so this was don't forget the graphic in there with the picture of the house literally falling over the cliff and the word plunge, and as though plunge had already happened. I think at the moment, the classic word is, or phrase is, from peak to trough, isn't it? So from peak to trough right now, what are we? Well, certainly as far as Zoopla are concerned.
We're just sort of down by about not even 1 or 2% on our house price index. Nationwide's down a little bit more, but again, it's not a recorrection, it's just a soft repricing that's happening at the moment. I think transaction volumes are off 20%.
Yep.
But again, the word plunge, plummet, probably not, given we come off such a high base.
That was my point I was going to make. They are off 20%, but on a crazy, if you look at what the UK market normally produces, and for ease of rounding numbers up and down, 1.2 million a year over a steady 5-year period, we're just sort of heading back in that general direction, aren't we? This was the last one of these property mark slides, which I thought was quite a useful one as well. And these are the average number of viewings per property. So these are not just people that have gone online or gone through a portal or whatever, but they've actually pitched up and gone to look at a property. And that steady climb is reflecting it again from December. A quick touch on the economic picture. I'm no economist. As I have to repeat on a regular basis. Right, okay, well, we're both in the same boat here. But obviously, it has a dramatic effect, certainly on consumer confidence, on people's disposable income. Yep. So these things do matter, and where they go matter. We all got caught out, I think if we're going to be honest, we all got caught out by the uptick in inflation last month, the February numbers. March came down, but probably not as much as people thought. The CPI, the classic index, stayed in double figures, double digits, 10.1. I don't know how you feel about what has the greatest effect, but I prefer the CPIH, which has home owner costs in it. That dropped down to 8.9. But I want to just show you a great chart. This was produced by the very wonderful Neil Hudson of Built Place, who showed that the massive jump in inflation last year was actually in March in 2022. Here's his trend line that he's drawn for the year for 2 years rather, from 21 to 23, and you can see that huge jump went on here, and next month that jump drops out of our numbers. Now, I'm guessing that I'm not going to make an economic forecast. We did touch on that.
Come on.
I'm guessing the inflation number, when we see next month's numbers, is going to begin with an 8.
Yeah.
And that's not 80-odd%, by the way. It's just 8 point something. Stuck this chart in. I won't dwell on it too long. But the ONS splits out the constituent parts of that inflation in the CPIH index. And the bit in the blue is all electricity, gas, and other fuels. Home energy costs, and I think that's a real and such a big chunk of those are going to go next month. So I think that we're going to see some really good news there. And on interest rates, well, we all know the last one went up 25 basis points in the March MPC. I'm of the view that we'll probably see another 25 points go on when they meet in May, and from the people I talk to, I get the sense that the markets have already priced that in. I don't know whether you feel the same. But when people look at this chart like this, and this is a chart that I've literally just taken straight off of the Bank of England website, it's like, here's interest rates, here's what we're used to, and look at this that's happened. It's absolutely extraordinary. But when you actually take that scale, you open that scale out and you go back a few years, this is what they look like. So this is 1995, and I deliberately took the 90s because that's after we had the huge hiatus in 1990, Black Wednesday and all that sort of stuff. And they're all about here. They're all about here. This is the outlier from 2008-9, when they basically stepped in to save the economy after the financial meltdown. And I think all we're doing is we're coming back to somewhere which is a little bit more close to normal. Your work on the mortgage rates and how it affects people's affordability and hence the market is fab. I look at these sometimes and I'm not sure I get them bang on. Talk us through these two charts.
Okay. Well, this is a version of what you've just shown, which is long-run mortgage rates, a 75% loan-to-value, 5-year fixed-rate mortgage. So you're absolutely right. It was up at sort of 4 to 6% back in the sort of pre-global financial crisis. Mortgage rates have fallen low in September 21. And yes, it's scary how much they rocketed up to 6%. They've now fallen back. So mortgage rates are about 4.39, 4.3 for a 5-year fix. But the most important thing about this is, and there was a big debate on this, and again, the media went crazy about how unaffordable mortgages were going to be and almost using that to back up the sort of big correction in house prices, et cetera, and all the headlines. I think how it affects consumers is more important. So this chart is basically showing that to buy an average price property with a 75% loan to value mortgage, with a 2% mortgage rate, I could afford £193,000 of debt. And that's £878 a month of mortgage repayments.
Gotcha.
If I keep my mortgage repayments fixed and I increase mortgage rates, I can buy less or take less mortgage, so it hits my buying power. So at 6% mortgage rates, we were facing into a 35% hit to consumers' buying power. Now we're back to mortgage rates of closer to 4%. It's 20%, but that doesn't mean prices are going to fall 20%. It means consumers
they're going to change their
put
target
more money,
property, aren't they?
change the target property, put in more equity.
Yes.
For those that can, borrow a bit more. Working from home means you can look further afield.
Spend a bit more of their disposable income on their mortgage.
And we've got to remember, half of all purchases a year are bought with no mortgage, or a mortgage of less than 50% of the value of your home. So it's not all. A lot of the narrative around the housing market is about everyone taking an 85% mortgage.
It's just not true.
It's not true. So, but this is real, and this is what the Telegraph talked about. But I think the good news is, a 20% hit to buying power is going to be a much lower drop in house prices.
I think I saw a slide in your recent deck that actually showed the number of properties in the UK that were owned outright with no mortgage. I think it's almost 50%.
55%.
55%. I knew it was an enormous number. And you're right, it's this fixation on interest rates and how that moves that fluid end at the market, isn't it? It's fascinating stuff. And certainly, there's lots of talk about why the nationwide index and the Halifax index have gone out of step and out of kilter. And people are saying, that's because one of them actually concentrates more on smaller property, and people have redirected themselves into smaller properties and stuff. This is possibly a reflection of what you're talking about there. This one here, now this you're going to really have. I've tried to sit and work with this. So why does that mean property is overvalued? I've got you today. Come on.
Let's go. So there's a question, and this is what a lot of economists do. It's all about, is the housing market over or undervalued? Because house prices are more likely to fall if the housing market's overvalued. And if the housing market's not overvalued, then they're less likely to fall. And this is a really simple model. So what we do is we just take quarterly since the 1980s, we just take what is the actual price of a house. So what's a house price index saying a house price is? And then we work out what's a sustainable or an affordable house price. What would a sensible person pay for a house at this point in time? And to work out that sustainable house price, we take the average household disposable income for everyone from ONS data. So we have a time series of, this is household disposable incomes that go up. We say we're going to spend 25% of that disposable income on mortgage repayments. So we have mortgage repayments over this whole period of time. We know what the average mortgage rate is over time, and we know what loan to values are. So we can work out what's a theoretically affordable house if I just spend 25% of my income on mortgage repayments. And this chart shows the difference between the actual house price and the theoretically affordable house price. And
do these correlate in your experience to how prices move? So are they a precursor of...
They are to some degree, So this is the late 80s. Where on this simple model, house prices were sort of 80% overvalued because people were investing and speculating with their own homes. MIRAS tax relief, mortgage rates.
Absolutely right.
And this overvaluation unwound through mortgage rates falling and then obviously house prices falling about 15 to 20%. And then they were undervalued here. And then in the mid-2000s, we got an overvaluation appearing again. But this is banks loosening off credit criteria, the rise of self-cert mortgages. In 2007, a third of people borrowing off banks did not prove their income to the bank. And that's when accidents can happen. People pay more for property than they should be.
I love the way you called it accidents. Some people might call it accidents. Other people might have a different word for it.
And now, look, for the whole of this period up until the middle of last year, housing looked fairly valued. Now, part of this is to do with all the mortgage regulations the Bank of England introduced from 2015 that stopped people borrowing too much. But when you take mortgage rates from 2% to 6%, it's going to create a paper overvaluation.
Which is what we've got here.
But the question is, how does that overvaluation unwind, as they say? And so the dotted line there at the end is, let's assume that mortgage rates fall back from 6 to 4% and prices fall by 5%. Well, the whole overvaluation dissipates, basically.
Yes.
And so, and this is a soft landing, and we said this at the end of last year, and it's sort of come true. And I think it just shows, again, there's lots of analysts doing all these sort of charts, and they can look really scary. You have headlines going, house prices are 40% overvalued, with the implication being they're going to fall 40%. Well, not if this happens, and this is what's happening, basically.
And can we just talk just for a moment about what is a house price? and I know that sounds like a really crazy thing to say, but so when I'm looking at indices and I can look at Rightmove and they'll offer me up an asking price, and I can look at Halifax and Nationwide and they'll offer me up a mortgage approval price where those mortgage approvals are done, and your index is that lovely blend of mortgage approvals, asking prices. Are these based on the Zoopla algorithm, or what prices are these?
This average price is a national average price that's Zoopla at the end. I mean, we take the average house.
Give your secrets away now, Richard. Come on.
We take the average price of the average value of all 25 million homes in the UK, basically, that are privately owned. So the back end here is Zoopla. We splice it together with government. I mean, it's a pretty, it's £260,000 at the moment, basically. So it's a real average. So, but again, this is just a model to highlight how does the housing market become overvalued and undervalued, and then effectively, again, particularly now, because I think for a lot of people, going from 2% to 6% mortgage rates sound really scary. You can create a lot of scary charts. And this chart was designed.
Scary news stories.
This chart was designed to show that actually you don't have to believe you don't have to be quite so scared on the way down on prices and things to actually for this overvaluation to disappear, basically.
Yeah, well, particularly when the reason I raise that is because when you talk about, I'm going to show you a chart out of old deck of yours because it's one of my favourites, and it talks about people giving discount to asking price.
Yeah.
And quite honestly, it's very, very close to this number. And I had a whole bunch of 200 plus salespeople in a room a little while ago, a few months ago, but a little while ago, and I said to them, if you wanted to sell your property for £350,000, how much would you put it on the market for? So I said, let's have a show of hands. Who in the room would put it on the market for £350,000? Now, there were over 200 people in that room, and not one single hand went up. Not one. We had a few at 355, very few, but a few more at 360, loads at 375. That seemed to be a bit of a sweet spot. Some even up to 400. Yeah. But the point is, that's how the English work, isn't it? I mean, for us, a house price, asking price, is the opening bid in a negotiation. And so when we talk about prices falling 5%, and we also know the developers generally, and even the institutions back in the day used to allow the developers to give away 5% before they penalised them on valuations, didn't they? So, back before Help to Buy and so on. And so that doesn't frighten me.
This is achieved price, basically. It's like, I could have achieved £100 last year. I can now achieve £95.
Gotcha.
Basically.
Okay. Well, it's a great chart. I understand it a lot better now, by the way. Even I do. I've stuck these up. We won't spend a lot of time talking about them, but it is really interesting. These are 2-year fixed mortgages, and you can see the direction of travel. These are 75% loan-to-value mortgages over varying terms, and the lowest one, interestingly, of those varying terms is the mauve line there, and the mauve line is 5-year money. And I always think that the finance guys, they tend to really know where it's going, don't they? I mean, that's well, up until 2008 they did anyway. And so the smart money is saying that for 5-year fixed, rates are looking down towards 4%. This is the nationwide. It's a couple of months old now, this chart, but they haven't updated it for this month. But I do think it's a really nice indication. We talk about mortgage rates, and whenever you talk to anyone that's my sort of age, they say, "Oh, 5-6% is not a problem. I remember when they went to 16%." And it reminds me a little bit like that old Monty Python sketch. But But of course, back then, comparatively speaking, in relation to average earnings, house prices were a lot lower.
Yeah.
And eventually, over the long run, we get this sort of 4.5 times earnings as that long run average, and we get it going up, and then a nightmare happens, whatever that might be, and then down it comes. Just before that, it was here, and then went through 1990, and then up here at 2008. And I just get the sense that what we're going to see is this: we're going to come back down towards this line again. It's that classic balance, isn't it, that stays within it. And when you come out of balance a long way, then there will be a correction.
Yep. I think there's two things really. I think just house price growth is going to be just much lower for longer. It's
Yes.
not going to fall, but house price growth is going to be more in line with earnings, which means this line goes sideways. But in some areas, we're probably going to continue to see that underperformance in house prices for the next 12 months or so. Probably, just small price falls, which would just drag this further down. I don't think we'll necessarily get right back to the long run average, but we'll probably close this gap halfway, I'd imagine.
Yeah, well, that's a good point you make, but there's 20 years in there.
Yep.
So you might well be right that not there, but if you imagine that sort of 20 years on, it will be interesting to see. It'll be really interesting to see. So despite everything that we've told you, and I need to keep an eye on time as well, we still have this situation with consumer confidence, which for me is such a reliable bellwether of the market. The market follows this trend. Everybody, certainly if you've seen a MarketCast before, you'll know that I talked about this last month. The mini budget, you know prizes for guessing when that happened on this chart. And these were all record lows on this survey that's been running since 1974. And since then, we've seen this very, very clear trend of improvement. This is the overall index score, the red one here, which from our low point has improved almost 20 points. And look, this is the line here where how people think the UK economy is going to do over the next 12 months. My word, that's what that has done since last September. And even people's view of how their own personal finances are going to go, again, from September through to April, it really is a significant transition. The green line here is whether people think it's a good or a bad time, the next 12 months, to make a major purchase. And you can see, okay, that's a lot flatter, but even that is trending up. Crucial to make the point, Richard, that the zero is there. If we were doing this 3 years ago, the zero used to be in the middle of the chart, because sometimes it was in positive. So we've got a challenging situation, a challenging market, because everything is in negative. Crucially, though, we've got that lovely upward trend. Rightmove, don't know whether you've ever heard of them, Richard, but that's another portal. And you can see their April numbers upticked slightly. Generally, their move from March into April is higher than that, but it's still an uptick across the piece in asking prices and in mortgage approvals. This is the Halifax index, and that upticked as well, 0.8%. And then if we look at yours now, your new one's coming out any minute, isn't it? When's your next week? I've got to work on the timing of my MarketCast so as I get your latest numbers. So when are your next ones due out? Out
next Wednesday, but I think that the rate of annual growth continues to slow, but I do think we're sort of coming, the worst of the price falls are behind us. Right. I think, things are we're not going to see prices fall, not going to rocket upwards, but I think we're at price stability now, basically.
You heard it here first. That's a MarketCast exclusive, by the way. So thank you for that little bit of insight. That's brilliant. And I stuck this up here deliberately, and it was ever so funny having that chat earlier about this, because I'm moaning to you because we haven't got Exeter on here, and I think Exeter should massively be a gateway to the southwest, home to lots of developers now. But it's not just Exeter who believe they should be on there, I understand.
No, I get a few sort of relatively irate people telling me that Bath should be on, Brighton should be on. I think we need to do a version of this map where all the house builders are building, basically, and maybe that'll keep everyone happy. That
would keep everybody happy. I've got a lot of my clients say, why isn't so-and-so on there? No, don't worry, I'll have a word with Mr. Donnell, see what he's got to say. Some really important indicators now, and you'll be aware I had a right old moan about this chart, because generally the press and the media tend to take just that comparison without looking at the bigger picture. And if you look, this is classic for demand, and there's demand almost 50% down on last year. Well, of course it is. Last year was a crazy year, wasn't it? Absolutely crazy year. But I love the way you've done this now. This is a much better representation of that, comparing it then with 2019.
Yeah.
And I think on the month before that, you compared it to those 5 years, 14 to 19, which I think is a really good. And as far as you're concerned, that, because this is going to come out again in a few days' time, are we going to see a similar sort of picture there?
It's broadly similar. I think the good news is sales are holding up because of maybe some pent-up demand from last year because people couldn't get what they wanted. The most important number for me here is the fact that there's just lots more choice for consumers.
Yeah.
Got 66% more homes for sale.
Yeah.
There's more choice. People have got more likelihood of doing deals. And what the industry wants, house builders, estate agents, lenders, we want transactions to happen because that's when we make our money. But obviously what's happening to house prices matters to consumers, basically.
Yeah,
and
absolutely.
so I think it's really important we've got more supply. I think the housing market's almost more imbalanced now than it's been for 5 years.
I agree. I absolutely agree. I kept this in. I know it's old.
Yeah.
This came from your February numbers, but I thought it was a really great piece of data. These are the discounts that people give to asking price. And you can see that prior to COVID here, 3%, which I actually thought was quite low, to tell you the truth. Then, of course, we had our crazy years, 2021, 2022, and here we are. And I think in your February numbers, you said that equated to about 18 grand.
It was 14,000 on average.
14,000, yeah.
So over the pandemic, the average household made 45,000 in their house price,
Right.
but they're giving away 14 now. So people are giving away a third of their pandemic gains to be able to move home, which is not, at least you're up.
Yeah, absolutely, yeah. And it's discounts to asking price. And we all know, don't we, about asking prices and so on. Explain this one to me, because
this is the complicated version of the previous one.
Ah, okay. So I see. It's essentially
the previous one is an annual average for everything, but I've just split out here London, the South East in purple, rest of the UK in pink, and it just highlights here how, again, before the pandemic, discounts were about sort of 2 to 4%. London was pretty weak in 2019, that crazy period where people were getting full asking price, which is the property market data. Yeah. But the gaps opened up with higher mortgage rates and the pandemic. But the good news is it's all starting to flatten out now. And so house prices, we should be worried about prices falling if these numbers were really shooting downwards.
Gotcha,
but because they're flattening out, again, it's more evidence that the housing market has seen a sort of soft landing.
Soft landing, absolutely, yeah. That's really, really good chart. And again, it's a little bit of a canary chart, isn't it? It allows us to future gaze. Yeah, absolutely right, yeah. Okay, and this is important too. A chart I really wanted to include. Obviously, since we lost Help to Buy at the end of 2013, they're trying to create enablers of financial products for first-time buyers has preoccupied certainly all my clients, all the developers, and this is a great way of showing how the mortgage rates switch that. Is it better to rent or buy? Don't they? And I know that you've split these out by regional markets as well. And I guess that's because the average price changed. Sorry, Richard.
No, it basically just says, I'm a renter. I'm pretty annoyed that rents are going up so fast and I want to buy. And it's simply an analysis of, if I were to buy the property I'm renting with an 80% loan to value mortgage at 4 and 5% mortgage rates, in all these regions, your mortgage repayments would be less than your rent.
Right.
So actually, because a lot of people think 4 and 5% mortgage rates are going to hammer first-time buyers, and first-time buyers are a really important audience for house builders.
Absolutely, they are.
But over here, I mean, it's cheaper to rent. It's cheaper to buy than to rent. Not in London, the South East, where house prices are higher.
Yeah.
And obviously, the big caveat with this is you need to get that deposit. So raiding the bank of mum and dad. But again, it's another one of these charts that goes, hang on a minute, media, it's not as
bad as you think. No. And of course, there are other products out there like shared ownership and what have you that can make that cost to entry lower. I think that certainly the for-profit registered providers are working hard to try and show that is actually not as a worrying tenure as people think, and it really is a great way to enter the market. Okay, so we're sort of running about 5 minutes in, and we've come to crunch time here.
Yep.
So this is the bit where we've got to say what we think is going to happen next, because quite honestly, there's been some super data there, but anybody can look backwards, can't they? So we're just looking forward. So let me share with you my method of, when I start to think about where's the market going to go next, to try and collect my thoughts, because this is where we go from left brain to right brain, isn't it? And this is where, okay, we've got all the data, we've armed ourselves with all the facts. Some of those canary slides on there, really great for future gazing, but then we need to think about all the factors that are actually going to affect the market as we look forward. So I sit with this thing and then I move them all around, depending on how things have changed. Mortgage availability, which is one of the most negative, high impact effects on the market. In November, that was here, literally here. And as mortgages have become more and more available, that has slid back into low impact status. We've still got higher than mortgage rates than people have been used to. So that still sits up very high, but not as high as it was. Consumer confidence is also moving back and up. And once that moves into positive, this will obviously be up in here. Homeowner running costs are high, affordability is tricky, and general inflation. But as I was saying to an audience I spoke to yesterday morning, that our target audience is less affected by that general inflation issue. And they have a higher proportion of their disposable income to spend on the items that sit in there, and I'm sure you find that too. My reason for putting these three up here in blue is because these are things that a developer or even a homeowner can do, offer discounts, creative financial products that we talked about, and part exchange. The mauve ones are political, so stamp duty, mainly taxation, stamp duty and the national insurance raise that they stopped, that didn't happen. I've called it a tax cut. And then these are market issues that we can't affect, but low supply, high demand that still sits there and buffeting or supporting prices, sorry. The hot employment market has moved back quite considerably. That's cooling, but it's still hot. And lifestyle changes are still there. This is something I know you study quite a bit, that we saw the race for space, didn't we? And the extra room for the study and all that sort of thing. Do you still think that's in evidence now?
Yeah, I think the pandemic is still having an impact. Working from home is here to stay and got further to run. Big spike in retirement. A lot of people thinking about that's a big trigger for moving. Cost of living, I think, is going to force people to move. Yeah. And again, house builders have got a fantastic opportunity. Low energy, high energy efficiency homes, lower running costs. What we've got to start doing is linking our marketing messages into what's driving household decisions. Good shout.
Well, this is where I think it brings us. So I've based it on the nationwide because I think you've got to base it on some index. Absolutely. Otherwise you're cheating. And if you don't have an index, you're always going to be right because they're everywhere, aren't they? So these in solid blue here are actuals. So we saw at the end of March, we saw nationwide year on year at minus 3.1, which meant that their average selling price, which is off this scale over here, sat at just about 258k, I think. And I am seeing April, and these numbers are out next week, by the way, so you can test these out. I'm seeing April will be still in negative, but an improvement from March, minus 2.1. And although it is a negative number year on year, the average price, if that is 2.1, will be a slight increase. And I think that will continue to increase into June. And I think it will stay solid through summer. So although compared to the big 2022 numbers, remember that was the peak, from the peak to trough that people are quoting, I think that will come to minus 4. Then we're comparing our numbers with a more difficult last quarter, and I think that they will ease. I'm seeing the year ending up at about minus 4, and the average, according to the nationwide, the average selling price at about 252. So how does that chime with your take then?
I think pricing is going to firm in the next few months, just because of those sales happening. I think pricing, the achieved pricing is going to firm. People are still going to have to offer a discount to the asking price.
Yes.
But we think at our index, we're going to be at minus 1 at the end of the year.
Right. Okay.
I think our index is a bit not as responsive as Nationwide's. But I think, look, and again, we said at the end of last year, prices would fall by up to 5%, no more. So I think 1 to 5 down. I think again, a lot of customers could deal with that.
Yes,
if they get the transactions, it's great.
Well, you said to me just before we started that every developer on the planet would love to see a steady price.
Exactly.
That would cause nobody any sleepless nights. So, and here to that. And then finally, how about volumes? Because we've seen some incredible dire predictions. There was one, I think the guy's name was Paul Smith in Property Industry Eye, said that there was going to be 30% reduction, which would have meant less than 800,000 transactions in a year. Come on. So these are where we currently sit here, and the non-seasonal, this is the result of that hiatus that we saw in the last quarter of last year. I personally see volumes between 1 and 1.1 million for the year ahead. I'm going to stick your slide up, which I nicked out of your presentation. So that's where you're forecasting for
sales.
The first half.
Yeah. So this is we're very lucky in that we can see sales being agreed subject to contract.
Yes, of course.
And so we look at all that data. It'll complete within 2 to 6 months. So effectively, already now we can see the pipeline for the first half. And so we think 500,000 completions in the first half of the year, which is a run rate of 1 million. But because the first half of this year includes the bad end to last year, so I think we should be disagreeing more, but I totally agree with you. 1 to 1 million is sort of where I think the market's going to turn out.
Fantastic. Richard, that was absolutely fantastic. Really brief summary then. This transition from want-based to needs-based, I think we're agreed on that. Mortgage hiatus artificially suppressed the market in the last quarter of 2022. And this pulse that we're seeing, there is an effect of that. Those people that wanted to buy back then that couldn't are coming through now. I can't believe sensible market commentators believe that we're going to see a crash in this cycle. Well, I've got negative inflation of about 4, you're about -1.
Yeah.
And on volumes, we're pretty similar, aren't we? It's been fascinating. It's been brilliant. Our first ever guest on MarketCast, not our last. Little bit disappointed you didn't wear the crazy shirt, Richard.
There's only room for one crazy shirt on this cast, I think.
Thank you so much.
Thanks very much.
What a pleasure. And I'll see you lot at the next MarketCast, which is on May the 23rd. So don't miss that. Huge thanks to Richard. Huge thanks to our production team, James, Joan, and Hannah. And it's a goodbye from me in Rosebery Avenue in London. See you next time.